For Chapter 4, what we are going to be looking at is preparing financial statements from the adjusted trial balance as well as closing entries from our adjusted trial balance. So what I have is wind in your sails, which is a problem that we've been working the whole semester. It's a comprehensive problem, and this is the adjusted trial balance that is for that. And what I wanted to do was break it down and show you what some of the information is actually looking at. So if we look at the top part of this information, what we're going to see is that up here, all the way down to here, we have our assets. The next part of our trial balance is going to show our liabilities. We then will be looking at the owner's equity information. We will have revenue accounts. And then we will list out our expense accounts. And so that's the way that the trial balance is supposed to be set up. Is it supposed to be set up with assets first, then your liabilities, your owner's equity, your revenue, then your expenses. What I suggest that all of my students do when they're looking at the adjusted trial balance is that you go through and draw a line right above the capital account, and you also draw a line right below the drawing account. What this allows us to do is look at the individual statements, because what you're going to see with all this information is where everything's kind of coming from. So when I look at this information, what I see is that this is your income statement, and that's what's going to come first. These are also part of your temporary accounts, and that's a new word for us in this particular chapter, is a temporary account. A temporary account is an account that we are going to close. So we are actually going to close these temporary accounts, which means that we are going to make it a zero balance. So we want these accounts to have a zero balance at the end of the year, because we don't want to carry forward any balances for revenue or income into the new year. We want to make sure that everything is zeroed out for the new year. And so that's the income statement. Those are going to be part of our temporary accounts. The other thing that we have is in between the blue lines is where we're getting our statement of owner's equity. So we'll actually do our income statement. We'll take our net income or net loss from the income statement. It's going to move up to the statement of owner's equity. Once we get and look at our statement of owner's equity, this is where we get our new capital balance, and that new capital balance from it will actually move up, and the rest of this information will be on the balance sheet. And so this is some of the information that we are going to be getting from the adjusted trial balance. So we can do one or two things. We can prepare the income statement and the rest of the financial statements first, or we can do the closing entries first. I prefer to go ahead and look at closing entries, because when looking at the closing entries, it kind of gives us our totals that we were going to need for our actual statement accounts. So in looking at all of this information, what we're going to find, let me move up. In doing the closing entries, we will actually do it based on the first thing is going to be an R. The R is revenue. So the first thing that we will close will be our revenue accounts. The second thing that we will close is our E, which stands for expenses. The next thing that we are going to close is going to be a new account called Income Summary. And the last thing that we're going to close is going to be the drawing account. So when we do closing entries, the thing you need to remember is R-E-I-D. And so that is what we're going to be looking at and how we are going to close all of these different entries. So when we look at the R, we actually have two accounts that are revenue accounts. And the first one is income from services, and the second one is concession income. So if I go back and I look at these two accounts, I see the amounts right here. Now you will notice that these are in the credit column. Since they are in the credit column, we need to debit these accounts to make them zero. And so our journal entry would actually look like this. So what we would have is we would have income from services, our other account that we would have would be the concession income. Income from services is going to be a total of $23,867. Concession income was $178. And so the total that we are going to be looking at here is going to be $24,045. That is the credit amount, and it will be credited to a brand new account called Income Summary. And so that's going to be your new account, and what we're going to have there is that Income Summary account. And so that would be that first entry where we are going to look at the R, or looking at our revenue and closing our revenue accounts. The next thing that we look at is the expense accounts. And so with expense, we actually have a lot of expenses on this particular one. So we will start out with our sailboat rental expense. And actually, the way we should actually start this, let's go back up and look at these accounts real quick. If you look, all of these particular accounts that we're going to be closing right here are on the debit side of the account. And so with that, that means that we would need to debit all of these, or credit all the expenses, because we need it to be a zero balance. So right now we're looking at a debit, so we would have to actually credit all of the expense accounts. And so what we would actually see when we do that is that the first account that we will use is going to be the income summary account. And that is going to be our debit account. And what I like to do is put a little box, because I don't know how much that's going to be yet. And I'll find that out once I get through putting all of the other accounts in. So then I will come down and I will put in all of my expense accounts. So I have sailboat rental for $700. I would have a wage expense for $9,683. I have advertising expense for $890. I will have utility expense for $1259. I will have interest expense, and my interest expense is $1351. Insurance expense is $1,000. Depreciation expense for the pool structure is going to be $715. Depreciation expense for the fan system would be $260. We would then have depreciation expense for the sailboats, and that amount is $900. And we would then have miscellaneous expense, and our miscellaneous expense would be $144. So the next thing that we are going to want to do here is we are going to want to total all of these amounts up, because this is our credit column. So you want to add all of those up. And so we have 700 plus 9683, 890, 1259, 1351, 1000, 715, 260, 900, and 144. And that is going to be a total amount. And we will put the total that we have in the box, which is going to be $16,902. Now remember, this is very important because our debits always have to equal our credits. And in this case, our debit would be the $16,902. If I add up all of my credits, then that also would be the $16,902. The next part of closing entries is the I. Now the I stands for income summary, and right now what we have, we need to look at a T account for this income summary account, and we had the $16,902 was our debit amount. Our credit amount was $24,045. So we need to actually look and see what the balance in this particular account is, and it would actually be $7,143. And so this is what we would be looking at doing our journal entry on, is this particular amount. So what we see is that we do have a credit balance. So in order to get rid of that, to make it a zero balance, we need our income summary account to have a debit. And so in this particular case, we will look at income summary, and our debit amount is going to be the $7,143. Now income summary is always going to be closed to our capital account. And so the other side of this particular entry is going to be our capital account for the $7,143. And so this gives us our amounts for that I. The next one we have is D. for D, this is our drawing account. So what we are going to have to do for this is we are going to have to look at that trial balance again. So if we come up and we look at the trial balance, what we find is that the drawing account currently has $4,300 debit. What this means is that we need to actually credit this account. And so the way that that is actually going to look is we will, the account that we close drawing to is the capital account. So we will have capital for the $4,300. The other side of that will be the drawing account for the $4,300. And so what this does is it really just closes all of the temporary accounts. And your temporary accounts are going to be any of your accounts that come below this capital account. So any of these accounts, from drawing, your revenue, and your expenses, these are actually going to be those temporary accounts that have to be closed. Now, what does that mean about the other accounts that we see on the actual statement? And what we find is that any of the accounts that are above the drawing accounts, or above this line, are going to be what we call permanent accounts. In other words, these do not close. So anything from capital up is going to be a permanent account. So we don't close our assets, we don't close our liabilities, and our capital account does not close. And that is the most common mistake that I see students make, is they try to close the capital account. The capital account will never close. Capital is a permanent account. So anything from here all the way up, so anything from capital, your mortgage payables, any of your payables, any of your assets, all of this information will not close. It is a permanent account. Now, with that being said, anything from that is below capital, which is your drawing account, all the way down to your expenses accounts will close because they are the temporary accounts. So those are some of the things that you really need to just remember and look at when we actually are going through and closing journal entries. In the next lesson, we're going to talk about using these closing entries that we have to actually prepare our financial statements.